Section 4 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 1, Before Our Very Eyes, Part 2. In 2000, when Cleveland was looking for help from the federal government, other cities around the country were doing the same. John Taylor, the president of the National Community Reinvestment Coalition, with the support of community leaders from Nevada, Michigan, Maryland, Delaware, Chicago, Vermont, North Carolina, New Jersey, and Ohio, went to the Office of Thrift Supervision, or OTS, which regulated savings and loan institutions, asking the agency to crack down on what they called exploitative practices they believed were putting borrowers and lenders at risk. The California Reinvestment Coalition, a nonprofit housing group based in Northern California, also begged regulators to act, CRC officials told the commission. The nonprofit group had reviewed the loans of 125 borrowers and discovered that many individuals were being placed into high-cost loans when they qualified for better mortgages, and that many had been misled about the terms of their loans. There were government reports, too. The Department of Housing and Urban Development and the Treasury Department issued a joint report on predatory lending in June 2000 that made a number of recommendations for reducing the risks to borrowers. In December 2001, the Federal Reserve Board used the HEPA law to amend some regulations. Among the changes were new rules aimed at limiting high-interest lending and preventing multiple refinancings over a short period of time if they were not in the borrower's best interest. As it would turn out, those rules covered only 1% of subprime loans. FDIC Chairman Sheila C. Bair, then an Assistant Treasury Secretary in the administration of President George W. Bush, characterized the action to the FCIC as addressing only a, quote, narrow range of predatory lending issues, unquote. In 2002, Gramlich noted again the increasing reports of abusive, unethical, and in some cases illegal lending practices. Bair told the commission that this was when, quote, really poorly underwritten loans, the payment shock loans, unquote, were beginning to proliferate, placing pressure on traditional banks to follow suit. She said that she and Gramlich considered seeking rules to rein in the growth of these kinds of loans. But Gramlich told her that he thought the Fed, despite its broad powers in this area, would not support the effort. Instead, they sought voluntary rules for lenders, but that effort fell by the wayside as well. In an environment of minimal government restrictions, the number of non-traditional loans surged and lending standards declined. The companies issuing these loans made profits that attracted envious eyes. New lenders entered the field. Investors clamored for mortgage-related securities, and borrowers wanted mortgages. The volume of subprime and non-traditional lending rose sharply. In 2000, the top 25 non-prime lenders originated $105 billion in loans. Their volume rose to $188 billion in 2002 and then $310 billion in 2003. California, with its high housing costs, was a particular hotbed for this kind of lending. In 2001, nearly $52 billion, or 25% of all non-traditional loans nationwide, were made in that state. California's share rose to 35% by 2003, with these kinds of loans growing to $95 billion, or by 84% in California in just 2 years. In those years, subprime and option ARM loans saturated California communities. Kevin Stein, the Associate Director of the California Reinvestment Coalition, testified to the commission. Quote, "We estimated at that time that the average subprime borrower in California was paying over $600 more per month on their mortgage payment as a result of having received the subprime loan," unquote. Gail Burks, president and CEO of Nevada Fair Housing, Inc., a Las Vegas-based housing clinic, told the commission she and other groups took their concerns directly to Greenspan at this time, describing to him in person what she called the metamorphosis in the lending industry. She told him that besides predatory lending practices, such as flipping loans or misinforming seniors about reverse mortgages, she also witnessed examples of growing sloppiness in paperwork, not crediting payments appropriately, or miscalculating accounts. Lisa Madigan, the Attorney General in Illinois, also spotted the emergence of a troubling trend. She joined state attorneys general from Minnesota, California, Washington, Arizona, Florida, New York, and Massachusetts in pursuing allegations about First Alliance Mortgage Company, a California-based mortgage lender. Consumers complained that they had been deceived into taking out loans with hefty fees. The company was then packaging the loans and selling them as securities to Lehman Brothers, Madigan said. The case was settled in 2002 and borrowers received $50 million. First Alliance went out of business, but other firms stepped into the void. State officials from around the country joined together again in 2003 to investigate another fast-growing lender, California-based AmeriQuest. It became the nation's largest subprime lender, originating $39 billion in subprime loans in 2003, mostly refinances that let borrowers take cash out of their homes, but with hefty fees that ate away at their equity. Madigan testified to the FCIC, quote, "Our multi-state investigation of AmeriQuest revealed that the company engaged in the kinds of fraudulent practices that other predatory lenders subsequently emulated on a wide scale, inflating home appraisals, increasing the interest rates on borrowers' loans, or switching their loans from fixed to adjustable interest rates at closing, and promising borrowers that they could refinance their costly loans into loans with better terms in just a few months or a year, even when borrowers had no equity to absorb another refinance," unquote. Ed Parker, the former head of AmeriQuest's Mortgage Fraud Investigations Department, told the commission that he detected fraud at the company within 1 month of starting his job there in January 2003. But senior management did nothing with the reports he sent. He heard that other departments were complaining he looked too much into the loans. In November 2005, he was downgraded from manager to supervisor and then laid off in May 2006. In late 2003, Prentice Cox, then a Minnesota Assistant Attorney General, asked AmeriQuest to produce information about its loans. He received about 10 boxes of documents. He pulled one file at random and stared at it. He pulled out another and another. He noted file after file where the borrowers were described as antiques dealers. In his view, a blatant misrepresentation of employment. In another loan file, he recalled in an interview with the FCIC a disabled borrower in his 80s who used a walker was described in the loan application as being employed in light construction. It didn't take Sherlock Holmes to figure out this was bogus, Cox told the commission. As he tried to figure out why AmeriQuest would make such obviously fraudulent loans, a friend suggested that he look upstream. Cox suddenly realized that the lenders were simply generating product to ship to Wall Street to sell to investors. I got that it had shifted, Cox recalled. The lending pattern had shifted. Ultimately, 49 states and the District of Columbia joined in the lawsuit against Ameriquest on behalf of more than 240,000 borrowers. The result was a $325 million settlement. But during the years when the investigation was underway, between 2002 and 2005, Ameriquest originated another $217.9 billion in loans, which then flowed to Wall Street for securitization. Although the federal government played no role in the Ameriquest investigation, some federal officials said they had followed the case. At the Department of Housing and Urban Development, we began to get rumors that other firms were running wild, taking applications over the internet, not verifying people's income or their ability to have a job, recalled Alphonso Jackson, the HUD secretary from 2004 to 2008, in an interview with the commission. Everybody was making a great deal of money, and there wasn't a great deal of oversight going on. Although he was the nation's top housing official at the time, he placed much of the blame on Congress. Cox, the former Minnesota prosecutor, and Madigan, the Illinois Attorney General, told the commission that one of the single biggest obstacles to effective state regulation of unfair lending came from the federal government, particularly the Office of the Comptroller of the Currency, or OCC, which regulated nationally chartered banks, including Bank of America, Citibank, and Wachovia, and the Office of Thrift Supervision, which regulated nationally chartered thrifts. The Office of the Comptroller of the Currency and the Office of Thrift Supervision issued rules preempting states from enforcing rules against national banks and thrifts. Cox recalled that in 2001, Julie Williams, the chief counsel of the Office of the Comptroller of the Currency, had delivered what he called a lecture to the state's attorneys general in a meeting in Washington, warning them that the OCC would quash them if they persisted in attempting to control the consumer practices of nationally regulated institutions. Two former OCC comptrollers, John Hawk and John Dugan, told the commission that they were defending the agency's constitutional obligation to block state efforts to impinge on federally created entities. Because state-chartered lenders had more lending problems, they said, the states should have been focusing there rather than looking to involve themselves in federally chartered institutions, an arena where they had no jurisdiction. However, Madigan told the commission that national banks funded 21 of the 25 largest subprime loan issuers operating with state charters, and that those banks were the end market for abusive loans originated by the state-chartered firms. She noted that the OCC was particularly zealous in its efforts to thwart state authority over national lenders, and lax in its efforts to protect consumers from the coming crisis. Many states nevertheless pushed ahead in enforcing their own lending regulations, as did some cities. In 2003, Charlotte, North Carolina-based Wachovia Bank told state regulators that it would not abide by state laws because it was a national bank and fell under the supervision of the OCC. Michigan protested Wachovia's announcement, and Wachovia sued Michigan. The Office of the Comptroller of the Currency, the American Bankers Association, and the Mortgage Bankers Association entered the fray on Wachovia's side. The other 49 states, Puerto Rico, and the District of Columbia aligned themselves with Michigan. The legal battle lasted 4 years. The Supreme Court ruled 5-3 in Wachovia's favor on April 17, 2007, leaving the OCC the sole regulator for mortgage lending. Cox criticized the federal government. Quote, "Not only were they negligent, they were aggressive players attempting to stop any enforcement actions. Those guys should have been on our side," unquote. Non-prime lending surged to $730 billion in 2004 and then $1 trillion in 2005, and its impact began to be felt in more and more places. Many of those loans were funneled into the pipeline by mortgage brokers, the link between borrowers and the lenders who financed the mortgages, who prepared the paperwork for loans and earned fees from lenders for doing it. More than 200,000 new mortgage brokers began their jobs during the boom, and some were less than honorable in their dealings with borrowers. According to an investigative news report published in 2008, between 2000 and 2007, at least 10,500 people with criminal records entered the field in Florida, for example, including 4,065 who had previously been convicted of such crimes as fraud, bank robbery, racketeering, and extortion. J. Thomas Cardwell, the commissioner of the Florida Office of Financial Regulation, told the commission that lax lending standards and a lack of accountability created a condition in which fraud flourished. Mark S. Savitt, a past president of the National Association of Mortgage Brokers, told the commission that while most mortgage brokers looked out for borrowers' best interests and steered them away from risky loans, about 50,000 of the newcomers to the field nationwide were willing to do whatever it took to maximize the number of loans they made. He added that some loan origination firms, such as Ameriquest, were absolutely corrupt. In Bakersfield, California, where home starts doubled and home values grew even faster between 2001 and 2006, the real estate appraiser Gary Crabtree initially felt pride that his birthplace, 110 miles north of Los Angeles, had finally been discovered by other Californians. The city, a farming and oil industry center in the San Joaquin Valley, was drawing national attention for the pace of its development. Wide-open farm fields were plowed under and divided into thousands of building lots. Home prices jumped 11% in Bakersfield in 2002, 17% in 2003, 32% in 2004, and 29% more in 2005. Crabtree, an appraiser for 48 years, started in 2003 and 2004 to think that things were not making sense. People were paying inflated prices for their homes, and they didn't seem to have enough income to pay for what they had bought. Within a few years, when he passed some of these same houses, he saw that they were vacant. For sale signs appeared on the front lawns, and when he passed again, the yards were untended and the grass was turning brown. Next, the houses went into foreclosure, and that's when he noticed that the empty houses were being vandalized, which pulled down values for the new suburban subdivisions. The Cleveland phenomenon had come to Bakersfield, a place far from the Rust Belt. Crabtree watched as foreclosures spread like an infectious disease through the community. Houses fell into disrepair and neighborhoods disintegrated. Crabtree began studying the market. In 2006, he ended up identifying what he believed were 214 fraudulent transactions in Bakersfield. Some, for instance, were allowing insiders to siphon cash from each property transfer. The transactions involved many of the nation's largest lenders. One house, for example, was listed for sale for $565,000 and was recorded as selling for $605,000 with 100% financing, though the real estate agent told Crabtree that it actually sold for $535,000. Crabtree realized that the gap between the sales price and loan amount allowed these insiders to pocket $70,000. The terms of the loan required the buyer to occupy the house, but it was never occupied. The house went into foreclosure and was sold at a distress sale for $322,000. Crabtree began calling lenders to tell them what he had found, but to his shock, they did not seem to care. He finally reached one quality assurance officer at Fremont Investment and Loan, the nation's 8th largest subprime lender. "Don't put your nose where it doesn't belong," he was told. Crabtree took his story to state law enforcement officials and to the Federal Bureau of Investigation. "I was screaming at the top of my lungs," he said. He grew infuriated at the slow pace of enforcement and at prosecutors' lack of response to a problem that was wreaking economic havoc in Bakersfield. At the Washington, D.C. headquarters of the FBI, Chris Swecker, an assistant director, was also trying to get people to pay attention to mortgage fraud. "It has the potential to be an epidemic," he said at a news conference in Washington in 2004. "We think we can prevent a problem that could have as much impact as the S&L crisis." Swecker called another news conference in December 2005 to say the same thing, this time adding that mortgage fraud was a pervasive problem that was on the rise. He was joined by officials from HUD, the U.S. Postal Service, and the Internal Revenue Service. The officials told reporters that real estate and banking executives were not doing enough to root out mortgage fraud, and that lenders needed to do more to police their own organizations. Meanwhile, the number of cases of reported mortgage fraud continued to swell. Suspicious activity reports, also known as SARs, are reports filed by banks to the Financial Crimes Enforcement Network, or FinCEN, a bureau within the Treasury Department. In November 2006, the network published an analysis that found a 20-fold increase in mortgage fraud reports between 1996 and 2005. According to FinCEN, the figures likely represented a substantial underreporting, because 2/3 of all the loans being created were originated by mortgage brokers who were not subject to any federal standard or oversight. In addition, many lenders who were required to submit reports did not, in fact, do so. "The claim that no one could have foreseen the crisis is false," said William K. Black, an expert on white-collar crime and a former staff director of the National Commission on Financial Institution Reform, Recovery, and Enforcement, created by Congress in 1990 as the savings and loan crisis was unfolding. Former Attorney General Alberto Gonzales, who served from February 2005 to 2007, told the FCIC he could not remember the press conferences or news reports about mortgage fraud. Both Gonzales and his successor, Michael Mukasey, who served as Attorney General in 2007 and 2008, told the FCIC that mortgage fraud had never been communicated to them as a top priority. National security was an overriding concern, Mukasey said. To community activists and local officials, however, the lending practices were a matter of national economic concern. Ruhi Makkar, a lawyer who worked on foreclosure cases at the Empire Justice Center in Rochester, New York, told Fed Governors Bernanke, Susan Bies, and Roger Ferguson in October 2004 that she suspected that some investment banks, she specified Bear Stearns and Lehman Brothers, were producing such bad loans that the very survival of the firms was put in question. "We repeatedly see false appraisals and false income," she told the Fed officials, who were gathered at a public hearing period of a Consumer Advisory Council meeting. She urged the Fed to prod the Securities and Exchange Commission to examine the quality of the firm's due diligence. Otherwise, she said, serious questions could arise about whether they could be forced to buy back bad loans that they had made or securitized. Mocker told the board that she feared an enormous economic impact could result from a confluence of financial events: flat or declining incomes, a housing bubble, and fraudulent loans with overstated values. In an interview with the FCIC, Mocker said that Fed officials seemed impervious to what the consumer advocates were saying. The Fed governors politely listened and said little, she recalled. They had their economic models, and their economic models did not see this coming, she said. We kept getting back, "This is all anecdotal." Soon, non-traditional mortgages were crowding other kinds of products out of the market in many parts of the country. More mortgage borrowers nationwide took out interest-only loans, and the trend was far more pronounced on the West and East coasts. Because of their easy credit terms, non-traditional loans enabled borrowers to buy more expensive homes and ratchet up the prices in bidding wars. The loans were also riskier, however, and a pattern of higher foreclosure rates frequently appeared soon after. As home prices shot up in much of the country, many observers began to wonder if the country was witnessing a housing bubble. On June 18, 2005, The Economist magazine's cover story posited that the day of reckoning was at hand, with the headline, "House Prices After the Fall." The illustration depicted a brick plummeting out of the sky. "It is not going to be pretty," the article declared. How the current housing boom ends could decide the course of the entire world economy over the next few years. That same month, Fed Chairman Greenspan acknowledged the issue, telling the Joint Economic Committee of the U.S. Congress that, quote, "the apparent froth in housing markets may have spilled over into the mortgage markets," unquote. For years, he had warned that Fannie Mae and Freddie Mac, bolstered by investors' belief that these institutions had the backing of the U.S. government, were growing so large with so little oversight that they were creating systemic risks for the financial system. Still, he reassured legislators that the U.S. economy was on a reasonably firm footing, and that the financial system would be resilient if the housing market turned sour. The dramatic increase in the prevalence of interest-only loans, as well as the introduction of other relatively exotic forms of adjustable-rate mortgages, are developments of particular concern, he testified in June. Quote, "To be sure, these financing vehicles have their appropriate uses. But to the extent that some households may be employing these instruments to purchase a home that would otherwise be unaffordable, their use is beginning to add to the pressures in the marketplace. Although we certainly cannot rule out home price declines, especially in some local markets, these declines, were they to occur, likely would not have substantial macroeconomic implications. Nationwide banking and widespread securitization of mortgages makes it less likely that financial intermediation would be impaired than was the case in prior episodes of regional house price corrections," unquote. Indeed, Greenspan would not be the only one confident that a housing downturn would leave the broader financial system largely unscathed. As late as March 2007, after housing prices had been declining for a year, Bernanke testified to Congress that the problems in the subprime market were likely to be contained. That is, he expected little spillover to the broader economy. Some were less sanguine. For example, the consumer lawyer Sheila Canavan of Moab, Utah, informed the Fed's Consumer Advisory Council in October 2005 that 61% of recently originated loans in California were interest only, a proportion that was more than twice the national average. That's insanity, she told the Fed governors. That means we're facing something down the road that we haven't faced before, and we are going to be looking at a safety and soundness crisis. On another front, some academics offered pointed analyses as they raised alarms. For example, in August 2005, the Yale professor Robert Shiller, who along with Carl Case developed the Case-Shiller Index, charted home prices to illustrate how precipitously they had climbed and how distorted the market appeared in historical terms. Shiller warned that the housing bubble would likely burst. In that same month, a conclave of economists gathered at Jackson Lake Lodge in Wyoming in a conference center nestled in Grand Teton National Park. It was a who's who of central bankers, recalled Raghuram Rajan, who was then on leave from the University of Chicago's Business School while serving as the chief economist of the International Monetary Fund. Greenspan was there, and so was Bernanke. Jean-Claude Trichet, the president of the European Central Bank, and Mervyn King, the governor of the Bank of England, were among the other dignitaries. Rajan presented a paper with a provocative title, "Has Financial Development Made the World Riskier?" He posited that executives were being overcompensated for short-term gains, but let off the hook for any eventual losses. The IBG-YBG syndrome. Rajan added that investment strategies such as credit default swaps could have disastrous consequences if the system became unstable, and that regulatory institutions might be unable to deal with the fallout. He recalled to the FCIC that he was treated with scorn. Lawrence Summers, a former U.S. Treasury Secretary who was then president of Harvard University, called Rajan a Luddite, implying that he was simply opposed to technological change. I felt like an early Christian who had wandered into a convention of half-starved lions, Rajan wrote later. Susan M. Wachter, a professor of real estate and finance at the University of Pennsylvania's Wharton School, prepared a research paper in 2003 suggesting that the United States could have a real estate crisis similar to that suffered in Asia in the 1990s. When she discussed her work at another Jackson Hole gathering 2 years later, it received a chilly reception, she told the commission. It was universally panned, she said, and an economist from the Mortgage Bankers Association called it absurd. In 2005, news reports were beginning to highlight indications that the real estate market was weakening. Home sales began to drop, and Fitch Ratings reported signs that mortgage delinquencies were rising. That year, the hedge fund manager Mark Klipsch of Oryx Credit Corp told participants at the American Securitization Forum, a securities trade group, that investors had become over-optimistic about the market. I see a lot of irrationality, he added. He said he was unnerved because people were saying, "It's different this time," a rationale commonly heard before previous collapses. Some real estate appraisers had also been expressing concerns for years. From 2000 to 2007, a coalition of appraisal organizations circulated and ultimately delivered to Washington officials a public petition signed by 11,000 appraisers and including the name and address of each. It charged that lenders were pressuring appraisers to place artificially high prices on properties. According to the petition, lenders were blacklisting honest appraisers and instead assigning business only to appraisers who would hit the desired price targets. The powers that be cannot claim ignorance. The appraiser Dennis J. Black of Port Charlotte, Florida, testified to the commission. The appraiser Karen Mann of Discovery Bay, California, another industry veteran, told the commission that lenders had opened subsidiaries to perform appraisals, allowing them to extract extra fees from unknowing consumers and making it easier to inflate home values. The steep hike in home prices and the unmerited and inflated appraisals she was seeing in Northern California convinced her that the housing industry was headed for a cataclysmic downturn. In 2005, she laid off some of her staff in order to cut her overhead expenses in anticipation of the coming storm. 2 years later, she shut down her office and began working out of her home. Despite all the signs that the housing market was slowing, Wall Street just kept going and going, ordering up loans, packaging them into securities, taking profits, earning bonuses. By the third quarter of 2006, home prices were falling and mortgage delinquencies were rising, a combination that spelled trouble for mortgage-backed securities. But from the third quarter of 2006 on, banks created and sold some $1.3 trillion in mortgage-backed securities and more than $350 billion in mortgage-related collateralized debt obligations. Not everyone on Wall Street kept applauding, however. Some executives were urging caution as corporate governance and risk management were breaking down. Reflecting on the causes of the crisis, Jamie Dimon, CEO of J.P. Morgan, testified to the FCIC, "I blame the management teams 100% and no one else." At too many financial firms, management brushed aside the growing risks to their firms. At Lehman Brothers, for example, Michael Gelband, the head of fixed income, and his colleague Madeline Antoniuk warned against taking on too much risk in the face of growing pressure to compete aggressively against other investment banks. Antoniuk, who was the firm's chief risk officer from 2004 to 2007, was shunted aside. At the senior level, they were trying to push so hard that the wheel started to come off, she told the commission. She was reassigned to a policy position working with government regulators. Gelband left. Lehman officials blamed Gelband's departure on philosophical differences. At Citigroup, meanwhile, Richard Bowen, a veteran banker in the consumer lending group, received a promotion early in 2006 when he was named business chief underwriter. He would go on to oversee loan quality for over $90 billion a year of mortgages underwritten and purchased by Citi Financial. These mortgages were sold to Fannie Mae, Freddie Mac, and others. In June 2006, Bowen discovered that as much as 60% of the loans that Citi was buying were defective. They did not meet Citigroup's loan guidelines and thus endangered the company. If the borrowers were to default on their loans, the investors could force Citi to buy them back. Bowen told the commission that he tried to alert top managers at the firm by email, weekly reports, committee presentations, and discussions. But, though they expressed concern, it never translated into any action. Instead, he said, there was a considerable push to build volumes, to increase market share. Indeed, Bowen recalled, Citi began to loosen its own standards during these years up to 2005. Specifically, it started to purchase stated income loans. So we joined the other lemmings headed for the cliff, he said in an interview with the FCIC. He finally took his warnings to the highest level he could reach. Robert Rubin, the chairman of the Executive Committee of the Board of Directors and a former U.S. Treasury Secretary in the Clinton administration, and 3 other bank officials. He sent Rubin and the others a memo with the words, "Urgent, read immediately" in the subject line. Sharing his concerns, he stressed to top managers that Citi faced billions of dollars in losses if investors were to demand that Citi repurchase the defective loans. Rubin told the commission in a public hearing in April 2010 that Citibank handled the Bowen matter promptly and effectively. Quote, "I do recollect this, and that either I or somebody else, and I truly do not remember who, but either I or somebody else sent it to the appropriate people. And I do know factually that was acted on promptly and actions were taken in response to it," unquote. According to Citigroup, the bank undertook an investigation in response to Bowen's claims, and the system of underwriting reviews was revised. Bowen told the commission that after he alerted management by sending emails, he went from supervising 220 people to supervising only 2. His bonus was reduced, and he was downgraded in his performance review. Some industry veterans took their concerns directly to government officials. J. Kyle Bass, a Dallas-based hedge fund manager and a former Bear Stearns executive, testified to the FCIC that he told the Federal Reserve that he believed the housing securitization market to be on a shaky foundation. Quote, "Their answer at the time was, and this was also the thought that was homogeneous throughout Wall Street's analysts, was home prices always track income growth and jobs growth. And they showed me income growth on one chart and jobs growth on another and said, we don't know what you're talking about because incomes are still growing and jobs are still growing." And I said, "Well, you obviously don't realize where the dog is and where the tail is and what's moving what," unquote. Even those who had profited from the growth of the non-traditional lending practices said they became disturbed by what was happening. Herb Sandler, the co-founder of the mortgage lender Golden West Financial Corporation, which was heavily loaded with option ARM loans, wrote a letter to officials at the Federal Reserve, the FDIC, the Office of Thrift Supervision, and the Office of the Comptroller of the Currency, warning that regulators were too dependent on ratings agencies. And, quote, "There is a high potential for gaming when virtually any asset can be churned through securitization and transformed into a AAA-rated asset. And when a multi-billion-dollar industry is all too eager to facilitate this alchemy," unquote. Similarly, Louis Ranieri, a mortgage finance veteran who helped engineer the Wall Street mortgage securitization machine in the 1980s, said he didn't like what he called the madness that had descended on the real estate market. Ranieri told the commission, "I was not the only guy. I'm not telling you I was John the Baptist. There were enough of us, analysts and others, wandering around going, 'Look at this stuff,' that it would be hard to miss it." Ranieri's own Houston-based Franklin Bank Corporation would itself collapse under the weight of the financial crisis in November 2008. Other industry veterans inside the business also acknowledged that the rules of the game were being changed. Poison was the word famously used by Countrywide Mozilla to describe one of the loan products his firm was originating. In all my years in the business, I have never seen a more toxic product, he wrote in an internal email. Others at the bank argued in response that they were offering products pervasively offered in the marketplace by virtually every relevant competitor of ours. Still, Mozilla was nervous. There was a time when savings and loans were doing things because their competitors were doing it, he told the other executives. They all went broke. End of section 4, end of part 2 of chapter 1.